just messed it up. All right, here we go. So, lot to discuss again this week. From Moody's downgrading U.S. debt to the House passing a massive budget reconciliation to an announcement of new tariffs on the EU that were then reversed, including maybe tariffs on Apple for not producing every iPhone in the U.S. So we got a lot to cover. So let me jump. Just make sure I just pause. I'm having a little problem here. One sec. All
There
right.
was a time when I would do your slides, if you need that.
Oh, I think, give me 1 second. All right.
I'd rather not volunteer, but
we back on screen here?
you've started screen sharing. There you go.
Okay. So Mark likes to do what scares and excites. For me, what has scared me for some time, and going back probably a couple of years, Mark, debt's been my number one thing, followed by a global leadership void. I think we're feeling the effects of both right now. But I saw this quote years ago, and it's one I think should be taught in every school to every person in the United States from the time they're kids up, to understand that debt has a lot of positive uses, but it is your current consumption of future earnings, whether you're a company, a country, or a household. And people forget this, and the bill does come due. And I think we're starting to see the debt problem really come to the fore. A little surprising with Moody's waking up to realize that the U.S. has a debt problem 13 years after the S&P downgraded the U.S. debt in August of 11. Fitch did it in August of 23. So this isn't a really big surprise, the downgrading of the debt. What's a bigger surprise is the focus on the U.S. and not the focus on the rest of the world. And I don't know if people caught the Japanese prime minister last week suggesting that Japan's fiscal situation was worse than Greece's. And that was before an auction that lacked really meaningful demand. So they came up well short in the indirect bidding on that auction, and was not the best look for the government. And now you're seeing a spike in rates in the last month. I think the long rates in Japan were up over 1%. On a 10-year bond, up 1% is about a 19% loss. So just think of it that way. On the other side of the coin, we have really exciting things going on, which we're going to be talking about all throughout Seattle, which is the innovation leading to productivity improvements, the reindustrialization that's going on, and the infrastructure spend is driving capital flows. National security spend continues to rise. The healthcare advances are amazing, and they're lowering healthcare costs. And we have to figure out a way to power up the future economy. And these are the areas that are going to continue to attract capital. So while we have this big debt problem on one side, and what I would consider bad leadership globally right now, to deal with big problems, we have this innovation that's going on. And I think one of the big themes for me in the US is a lot of the costs that the federal government's doing is pushing costs either to the states or to the private sector. The private sector in many cases can handle it because of the strong balance sheets of the large corporations. Smaller companies are not going to be as well positioned to deal with that. And if it's being pushed on to the states definitely don't have the wherewithal to deal with spending increases coming towards them away from the federal government. So there's a lot of contradictions going on. And further adding to that, the change in terms of trades are really distorting a lot of the economics. So
it is to clean my teeth.
when you step back, the Moody's downgrade,
What did they get you for that?
200.
The problem,
Really?
Yeah, what do you pay? 170.
Like 115? Is that right?
Yeah.
Duncan.
It does highlight the problem right now. The dotted line is the public debt. As you can see, that's been accelerating. So is the total debt moving up in tandem. This is a pretty significant issue if we don't have the growth to match it. And the real issue, though, is the interest costs on the rise. And if you think out right now, net interest is about 3.2% of GDP. It's projected by 2034 to be upwards of 4.2% of GDP. So once you pass having your interest costs pass your defense spending, it's usually seen as a sign of a global leader seeing its final stages of global leadership. This is a point that Niall Ferguson's made multiple occasions, and it's something definitely for the US to keep an eye on. But the federal deficit was growing before the BBB. And by the way, BBB is a phrase used inside the Trump administration to label their big, bold, beautiful plan. The credit markets think of BBB very differently, and that is the last step before junk. And I think the irony of this should not be lost on investors as we're seeing a deficit growing towards 7% next year for the next 2 years is projected, and maybe moving to 7.4 in 28. But we're running pretty much 7% deficits for quite some time. So I think this is really the issue, and I'm not sure this is what's going to get us to the right fiscal place that we need to be as a nation. So a lot of this is going to be dependent on the growth that comes out of the initiatives that are being put forth by the administration. And it's very tough to count on future promised revenues on things like tariffs driving it, although the tariff number is on the rise. Will it be enough to offset some of the other challenges that we have? So think about the markets. This is a look at the S&P and the different issues that we had, starting with the election. Then we hit a record back in February, and then we started this line down. And on the way down, you can see really Liberation Day on April 2nd was what started to drive it to the bottom. Then we started to see a reversal of the tariffs, postpone. There's a new phrase on Wall Street I heard today, which is taco. Trump always caves. It's Trump always caves in or always caves out when there's a problem, and that's what you've seen with the downgrades. Friday it was 50% tariffs on Europe. Then it was deferred for till July 9th. You're going to see a lot of this whipsawing around, so keep an eye on that. In the bond area, we've seen rates spike, and look at this chart of the 10-year bouncing around the last couple of years. And even in the short term, we've seen a pretty big move up. What's interesting is we've seen a very significant move up from the time the Fed cut rates last September. And now we're moving back towards, on the 10-year, moving towards 4.6%. The 30-year crossed 5 and came back in. So rates are pushing up. I think one of the things for me is we're moving back to more historically normal interest rates and moving off the 15 years of suppressed interest rates through quantitative easing, through zero interest rates. And that is a change that I think is really slow to adjust to. I think that's when we have to get much tighter in how we're dealing with, realizing that the gift of the last 15 years is gone, and we're going to be struggling to work in an environment where you have, 4% interest rates or higher for the foreseeable future, with a bias upwards if we don't get our debt house in order. That's pushed a lot of people into gold. For one reason is looking at the alternatives of feeling the markets are overpriced, bond markets are a little challenged. Gold has been a favorite investment as people are looking to diversify. You can see Ed Yardeni's year-end target up at 4,000 and the 26 target at 5,000. And there's, I think, two reasons for this: high demand from consumers and governments shifting away from the dollar. And some of that is due to the dollar being under pressure. And you can see the chart here in nominal and real terms in the dotted line. But you can see the dollars took a leg down. One of the things I'd be careful about, though, is I think the bond market turmoil is going to put some strains on other governments. I mentioned Japan. Japan is no longer the world's largest creditor. They were surpassed by Germany, which, well, on one hand should be a badge of honor, but Germany needs to be spending some of that money. So I think you're going to see the dollar continue to be under somewhat pressure, but I think you're going to see other countries starting to feel the effects of their fiscal situation. Japan is maybe lining up for another downgrade, for a potential downgrade for them. You have other nations that are looking at really difficult fiscal positions, and the idea of moving away from the dollar is going to pick up steam, but it is a hard thing to do, and you'll see that I think it'll be more of a slow, gradual degradation rather than a big shift away, because I don't think the alternatives are there just yet. The real issue for policymakers right now is where is inflation going, because low inflation would allow them to continue to spend better. Higher inflation will really put the squeeze on things, forcing rates higher. And I think we've talked about the two-sided risk to inflation for a bit of time. And this is the New York Fed survey, and they're looking out 1 year, they're looking at maybe 3.6% inflation. 3 years, it's around 3%. And then if you go out 5 years, it starts to drop then down to trending towards Fed's target. Right now, the market is thinking, where's the Fed going to go? Are they going to cut? Are they not going to cut? And I actually have seen the argument for 2 cuts this year and no cuts coming from a lot of people, depending on the outcomes of the Senate and how they deal with the tax plan, as well as where the Fed is on interest rates and seeing how things are moving. But I think the Fed's in a bit of a bind right now. I think they're going to be a little bit more worried about inflationary pressures. Employment is still quite strong, and until they see the employment side weaken considerably, I think they're going to be biased towards holding rates where they are and not cutting as much as the market might like, or President Trump would like. So this is the 10 and the 30 year reflecting the concerns. And I think one of the issues why I think rates are going to be higher is it's getting harder to attract buyers because rates are moving up around the world. The Bund is now at, the Gild is now at higher than the US. You're starting to see Japan's rates moving off of zero considerably. Germany's rates are moving up. Rates are on the rise, so you're going to require more yield to attract buyers. And I think that's why people should be thinking about, for valuations, where the level of interest rates are going to be. And I think we should expect we'll be back at these higher levels for extended periods and not moving back down to where we were coming out of 23. So shifting to the plan, I think there are some really good things coming out of the tax plan. If they come through, it's a very unusual plan for the Republican Party, where they're not the tax cuts part and the extension of the tax cuts, but eliminating taxes on tips and overtime is a big deal. I was in Las Vegas this weekend, and I can tell you the workers there are skeptical that it's going to go through, but are very excited about that. If you're talking to seniors, the no tax on Social Security effectively, a big deal. But I think the green energy programs are going to get hit quite hard. I think there are other areas of the plan that are going to help drive capital into the US and drive business spending. I think some of the things that they're doing in terms of the business credits for new plant equipment are going to be real positives to support some of the reindustrialization that's going on in the US. But I think there's a lot in here for everyone. I'm not sure what the Senate gets through. I think, Mark, they will push back on trying to get some more cuts somewhere, but I don't think you're going to see a material change. And I think this is going to lead us with deficits of around 7% or higher. And that means we're going to really have to see the growth come, and you're going to have to see much greater productivity to work through the fiscal problems that are going to come out of this. The bill, on an estimate from the CBO, adds about 2.3 trillion in national debt. Others are saying it's going to be 3 to 5 trillion additional debt, depending on whether they make some of these cuts permanent or not. I think it is expansionary in the short term because the spending cuts and the tax increases are delayed. The new tax cuts are immediate, and in some cases might be retroactive to the start of the year. I think you will see for states like the blue states, the SALT tax is going to help some people there. The IRA subsidies are going to be very impacted. These Medicaid work requirements are highly controversial, but I think the expensing of equipment and R&D is going to be a big thing for a lot of businesses and drive a lot of economic activity back to the US. I'm not sure we know the full effects of this yet, but for me, I think we have to really keep an eye on the interest rate and really focus on whether the government can get their fiscal house in order. And is there anybody in Washington, D.C. who actually has any sense of the long term and how we're going to manage through the debt loads? Through all this, though, the market keeps rising up, and I think we will continue to see the markets push ahead because of the positives out there, and because a lot of this program is short-term stimulative, longer-term some challenges. So, Mark, I'm going to stop there, and I think if you want to turn it over, I'll turn it back to you. You want to go
So
right to your question?
Yes, this is Olga. I'm going to jump in. So we put together actually a client alert on Thursday about some of the provisions of the One Big Beautiful Bill. And what's interesting is that carried interest that was discussed by the Trump administration was not included in it. So, people could take a breath of relief that carried interest is not going to be affected. But what's interesting is that the sole deduction, even though the bill increases the deductible amount, it really negatively affects any private equity fund managers, doctors, lawyers, accountants, anybody who is in the service business. Because what we used to have is a pass-through entity deduction, where, for example, as a partner in a partnership, Winston and Strawn would make an election to pay state taxes at the entity level, and I would have the effect of the deduction. So it's basically anyone who is in the service business, welcome back to the $10,000 limitation. Okay, so that extremely negatively affects anybody who is in financial services, legal, accounting, everything under the sun. So we cannot use this deduction anymore. What else is interesting about the provisions in the bill? Of course, the positives are that there's the freezing marginal tax rates, permanent reduced marginal U.S. federal income tax rates, 37%. Then expanding deductibility of qualified business income. So it was a 20% 199A deduction. Now it's 23%. What else is interesting? Permanently expanding estate and gift tax exemption amounts. So that is a permanent extension. Extend bonus depreciation, relaxation of limitations on business interest expense deductions. So those are positive things. And one thing that I wanted to point out is that something that Mark, you and I discussed previously at our presentations, the opportunity zones. Remember, we talked about it quite a lot, and they were very popular. Then the sort of
2018 or 19, we were.
Yes, they went away. So now the Big Beautiful Bill Act extends the investment period through December 31, 2033, and permits the designation of new zones, but narrows eligibility for such designations. So it's basically renewed. So let's see. I mean, there are different provisions out there that apply, for example, to certain tax-exempt entities. There's increased excise tax on investment income of certain private colleges and universities. So they're subject to 1.4% tax on their net investment income. And that act would increase the tax rate up to a rate of 21% for institutions with student adjusted endowments of 2 million or greater. So I think that's quite, a big of a jump, and the 2 million or greater of endowment is not a lot. So that's a big change for the universities, private colleges and the universities. And then also there's increased tax on net investment income of certain private foundations. So that's up to the rate of 10% for foundations with assets of 5 billion or more. So that could affect some of the foundations that we'll work with. And again, there are proposals effective clean energy tax credits. So there's acceleration of the expiration of clean energy tax credits enacted by the 22 Inflation Reduction Act. So the expiration is accelerated to December 31, 2025. Yes, it's pretty crazy. So it's credit on the clean vehicles, commercial clean vehicles, alternative fuel programs, residential clean expenditures. By the way, so I personally put in a solar roof. I better claim this deduction ASAP before it goes away because that's, this year is the last year. And so that's,
But on that
yes.
point, nuclear, Andy Fisch, we've talked about nuclear a lot. Nuclear got some deduction treatment or tax credit treatment.
Yes, so nuclear is still okay, but anything that is electric, wind, any kind of alternative energy other than nuclear is significantly cut back or eliminated. So, and there are some international provisions that deal with basically guilty taxes that are going to be expanded. It says freezing deduction for global intangible low taxed income for foreign derived intangible income. So freezing base erosion and anti-abuse tax rates. And there is a new section 899, which would permit increases to statutory rates for certain income and excise taxes applicable to residents of discriminatory foreign countries that are deemed to have imposed unfair foreign taxes on U.S. persons. So this is yet to be seen. So we don't know what this, new section 899 will hold. So it just basically says up to maximum increase of 20%. So there's a lot of provisions, and I think, you could spend a whole hour talking about them. But I mean, like, things that my clients are asking who a lot of private equity funds, the answer is, carried interest is not in this BBB. Um, pass-through entity taxes, bad news for private equity fund managers. So, and and kind of other provisions that may affect the way that they do business.
Well, you just listed a lot of things, so maybe we take a beat. Questions to Olga?
Yes, I'm just looking if there are any questions that have cropped up.
Hey, Mark,
Yeah.
this is Greg. I think Olga did a great job, but two things
Hey,
I
Greg.
think are worth highlighting. Well, before I say that, I agree there's going to be some changes in the Senate, but I think we got a really good framework. And as you know, the Trump administration's hell-bent on getting this thing signed by July 4th. So I do think we'll have something pretty concrete to talk about in July, maybe by the time of your conference in Rhode Island. But people, 99% of the articles you read about the SALT deduction talk about it as being related only to the blue states, but it affects all states. People forget that also includes property taxes and sales taxes. And I'm in a modest house here in Dallas and pay, $13,000 in real estate taxes and spend way too much money. So if I added up all the sales tax plus that, it's going to easily double my deduction. It's not going to help the rank and file people, but it helps people in Florida and Texas and everywhere else. I think that's a point that's getting missed by everybody. That's why it is such a big dollar amount that they're fighting over. And then two, on the opportunity zones, I got to go back and read it, and Olga may have read it further than I have, but I don't think it provides any relief at all for sales made this year and possibly even next year. It begins in 2027 and provides a deferral to 2030. And I think we're still stuck with the same law now, which only gives a deferral till 2026. So I think they pushed that out a little bit. We'll have to see what happens with that, because that's a big ticket item too, the opportunity zones. And I know it's one that's discussed here a lot. So there's a lot of effective date provisions that are all subject to change.
Should we do?
And she's right. It would take a 2-hour debrief to go through everything.
Yes,
Well,
yes.
well, that's my point. Maybe what we need to do is do that. I don't know, we can pull the trigger with even 2 days notice, but let's just think about it, maybe a couple weeks time.
Yeah. I think you revisit it in a month and see where we are right before the 4th
Yes.
of July holiday.
Yeah, I see there's a question saying what happened with private equity. Yes, carried interest did hold into capital gains treatment, even though, Trump said a couple of weeks ago, 3 weeks ago, saying that we're going to close carried interest deduction loophole. I mean, I don't know, there was never a deduction, but there was nothing mentioned in the BBB regarding carried interest whatsoever. So it's still, it still is long-term capital gains as long as the fund holds portfolio investment for more than 3 years. So that's still capital gains. I see there's some other questions.
Yeah, Andy, Anthony, Bill, Michael.
Yeah, just a quick comment is the green tax credits, solar and wind are actually dwarfed by things like heat pumps, water heaters, insulation, and that really doesn't apply to big corporations. That's people, that's somebody taking out their oil burner and replacing it with a heat pump. So we tend to think of solar farms and stuff, but
Okay.
the numbers are small there.
Anthony? Thanks, Andy.
Hi, how about focusing on any positive attributes? Like just say, okay, what's new that's good? Make a list of that.
Well, I think I mentioned, so there's a permanent freezing of the top marginal rates. So the state and local tax deductibility for people that make, basically less than 500,000 is positive, but everybody else is negative. Let's see, expanded deductibility of qualified business income, positive. And so the tips, overtime, car loan interests, that's positive. Estate and gift tax exemption
Oh.
amounts increase, positive, right?
We won't talk about the deficit.
Keep
Yeah.
going.
If you
Keep
don't look at the
going.
deficit, there's a $4 trillion tax cut, depending on how you do
Yes.
the accounting. Right.
So, all
Yeah,
right.
so there's extended bonus depreciation.
Let's keep it going. Some other questions, Bill?
So, yes. Bill.
Here we
Would
go.
like-
Hey,
Yep.
yeah, thanks. Olga, could you go back over the tax on endowment foundations?
Yes, yes. So it basically says, here, let me get, okay, so let me see, hold on a second. So basically it increases tax on investments of certain universities, private universities. And that affects the, universities that have student endowments of excess of 2 million, which seems to be like not a lot. So that,
What is the increase? What is the tax difference now?
so the increased tax is, hold on a second, let me just find this.
It's like
Okay,
1.5% now. It's
yeah,
a
so it's
huge increase.
1.4%. So it's a section 4968. So they're subject to tax of 1.4% on net investment income. Okay. So the BBB Act would increase the rate of tax imposed on certain private colleges and universities based on the institution's student adjusted endowment, up to a rate of 21% for institutions with student adjusted endowments of 2 million or greater.
Yeah, that's a huge increase too. It's
Yes.
basically the corporate rate compared to 1.5%. So,
Yes,
But
yes,
that's on the investment income? It's on the
yes,
Yes.
net investment income, yes.
Sorry,
Mhm.
what does student adjusted income mean? Is that like student per capita? Endowment per capita?
It's a
that the
student
equivalent?
adjusted, that's the way I read it. It's a student adjusted endowment of 2 million or greater. They can't say that, if the university has the entire endowment of 2 million or greater, then it would be subject to tax. It's got to be per student.
Yes.
Got it. So endowment per capita. Got it.
Yes.
Yeah.
So, and then the other one is increased tax on net investment income of certain private foundations. So, so right now, private foundations subject to excise tax of 1.39% of their net investment income. So the act would increase rate of tax imposed on such foundations based on the size of the foundation, measured with respect to the value of foundation's assets, up to a rate of 10% for foundations with assets of 5 billion or more.
Got it. So, Michael Hammer?
So I want to go back. Well, first a comment. Everybody talks about the permanent tax rates. No rates are permanent.
Yes.
If we, I mean, and we should remember that. You know, I am not a fan of this big, beautiful bill. You know, looking at things like salt, if people in particular states want to tax themselves higher, then they should tax themselves higher, and it shouldn't be pushed back to the federal government as a deduction. You know, there's so many things.
You and I both. I'm in here in New Jersey, but we can't do anything about it. It's I can't.
No, but I'm just saying that it distorts things economically. It provides what I would call perverse incentives. The other thing that, Stephen, I'm surprised you didn't mention is that there appears to be pushback in the Senate, and how that will modify this bill is
Yes.
yet to be seen.
Yeah,
Yes.
I mentioned there are a couple of holdouts, but I don't think they're going to do too much. I just don't.
Yeah. I mean, I know that a lot of the trade organizations are lobbying, like, like, for example, accountants and lawyers are lobbying against the elimination of the pass-through entity deduction for specified trades or businesses, so that's sort of it's taken people by surprise, but somebody has to pay for it, right? For salt deductions for other people. So I guess it's me.
So then, there's things that are still in there. Section 1202
Yes.
certainly benefits me. The depletion allowance for oil and gas certainly benefits me. And quite honestly, I would take a pass on some of these benefits if the federal government would get its act together, that is Congress, and seriously work to reduce the deficit. I mean, and I'm old enough that the deficit, when the bill comes due, is probably not going to hit me or change my lifestyle one iota. It's future generations that are going to be hit, and it's just a crying shame.
Okay.
Yes.
No argument here, Michael.
So, yeah, somebody was asking, is there anything about reducing tax rate on long-term capital gains? Nothing. No.
Carl, you got a question?
Yes. My question is, if from the side from people from the manufacturer's side, people who are doing hard things, steel companies, screw companies, manufacturing companies, the things that I'm doing, who rely on investments, the return is got to be somewhere, greater than the bond. But where do you think that that's going to play out? If you look at what's the return on investment that you want for the funds in a 5-year investment or a 10-year investment? Do you want 150%? Do you want 200%? That's my question.
You're asking want or expect.
Annually, I'll take 150% annually.
Carl, I think you're asking, is it as investors for a company like yours, what type of return are people looking for as a family office? Is that correct?
Absolutely. Yes.
Well, we're going to talk about that when you get back on vacation, Carl.
Yeah.
I'm letting you enjoy your vacation, but here you are.
Not only you, but I got, my phone's blowing up from the other side of the business too, yelling at me. There are no vacations anymore, I don't think.
Mark, it doesn't have anything to do with a specific question about returns, but there is, I think Olga covered it quickly, but there's expense provisions for manufacturers in the US to get deductions for expansions of business assets. I'm talking about real estate too. So that's a huge thing that would be an incentive for US manufacturers.
Yeah.
It does seem, Greg and Olga, that the plan was designed to support the reindustrialization efforts and all the reshoring that they're trying to do and accelerate it.
Yep.
So that theme, I think, is going to be one that you can carry through for a little bit of time with all the other uncertainty. Is they are going to drive capital back to the US, both through the trade negotiations and through this tax plan to incent incent money to flow into manufacturing.
Other comments, questions?
Hey,
Okay.
Stephen, I've got a question for you. It's Joe Azzaro. How are you?
How are you?
Good. Nice to hear from you today. I'm just curious. It seems like there's a lot of really positive momentum on certain things. We're getting a lot of deals done in overseas, potentially good news with tariffs coming down the line. We'll see. But I also see on the other side of things an extreme with like the yen carry trade potentially unwinding, maybe higher unemployment structurally due to artificial intelligence coming and taking a lot of jobs. Like, where do you really think it all balances out between tax cuts and manufacturing and everything, and the yen carry trade and everything else that's kind of going on in the global scale, as to whether or not this is a time to be really leaning in and long in stocks, or to kind of be a bit more conservative and take a page out of Warren Buffett's book and be a little bit more cash heavy? What's your macro kind of feel there?
I think this is a tough time, particularly right here, because you just saw from Friday to this morning a 50% tariff proposed for the EU and then reversed. If the 50% tariff went on, it would take the effective rate on tariffs from basically 14% to 18% from where they are globally right now. So it gets really hard, Joe, to overcommit right now to any area. I think you have to either have a view that you're going to take a longer term view and invest in the secular themes, which is what we do, or you're going to have to be a really good trader, because this is going to be, the volatility is not going to slow down. I think it's going to accelerate. And you've moved from just having really trade and tariffs as the issue to now the budgets and fiscal houses around the world. And it's not just the US. And I think one of the things that the US has gotten a lot of attention for all the negativity, and a lot of it well-deserved for the way we're rolling out these tariffs and the heavy-handedness to allies and adversaries. But at the same time, I think that the rest of the world is feeling a lot of pain. You look at Japan, and the spike in rates of 1% is not a good sign. Those are not positives. I think you have a lot of challenges elsewhere. So I think it's a time to be high conviction in the secular areas and low conviction in the non-secular ones. And you better be right on your secular themes. I think that's how you play it. And I think that this is an area where you almost want to be a VC in the public markets too, where you're going to be taking higher volatility and higher risk in the environment we're in, and you should make sure you're getting paid for it.
Okay, thank you.
Hi, Joe, by the way. Maher?
Hello,
Hey,
everybody. Hello,
Maher.
Stephen. I have a question for you. Let's say I'm interested to see what the feeling from perspective of venture capital and PE, how they analyze at the moment now. Let's say as I have a fresh investment projects, in terms of what do you expected, like projection expected to have IRR, ROI, what the inflations need to be embedded, for example, for the forecasting for the next 5 years. Those kind of see where we are in the benchmark. I'm just interested to get more elaborations on the top of Carl's question.
I would answer it for myself, but I would send it back to the community. But I think the idea of that you're going to have 2 to 3% inflation should be a comfortable number to keep in. And I think you need to think 4 to 5% on the 10-year and invest that way, as opposed to invest with the hope that we're going back to that the Fed's going to aggressively cut rates. Because I don't see the long end coming down, and I think the short end may come down a little bit, but I don't think there's the ability to push them down as quickly as people would like. So I think that's what I'm saying. I think we're going back to investing pre-08, where you had zero interest rates, and you have to think about the way you would invest without the help of the Fed providing you a good yield backdrop.
Okay, another question. If you are talking about raising debt, so what the debt covering ratio would be expected to be to match, we say we are on the safe side for the project stress testing, let's say?
I'd turn that back to the community. I don't have an answer for you on that one. maybe one of the venture guys could help you with that one.
I would say as a suggestion would be like 150% from debt covering ratio would be something is good, or there is a demand for high. I just put a question for community as well.
These are just non-profitable venture companies you're talking about? Maher?
No, basically what I'm doing, even in US, we are building a lot of, let's say, financial modeling for fundraising.
Right.
And that's something for different sectors, oil and gas, R&D project, medical devices,
Right.
you name it. So basically, it's like I'm interested all the time. We are always try to be, when I build the model for the client and a PG, try to be on the conservative side and try to analyze the whole business model 360-degree, like, from the investor point before we are addressing the result from the startup.
So the
investor.
question is how this current economic turbulence is impacting fundraising and venture capital.
Yes.
It's just a magnification of what has been happening over the last at least year, which is a massive flight to quality, which happens every time there's a disturbance in the market. It's a cycle we go through over and over again. So two things happen so venture gets exciting, more people flood in, funds have more money. Then they can't hire more people, so they write bigger checks. People get competitive, they pay high prices. 2021 was the high of the sugar high everybody talks about. Then the market shifts, people get upside down, they don't have liquidity, and venture folks say, well, don't worry about us. We exercise discipline the whole time, which they're full of it. But then they immediately start worrying about triage, which people are doing now. They worry about protecting their best companies, which people are worried about doing now. And then but they don't stop looking at new opportunities. They have capital to invest, but it is absolutely and only in the best companies. So if your companies are the best companies, the best founders running future public companies of exceptional opportunity, they'll be fine. Everybody else will suffer. The second best companies will at best take much longer to fundraise and will end up with much more aggressive terms. Here's the 3 stages I've been through in the last, Tenacity's 4 years in. So in the beginning, some entrepreneur would come in and say, we're doing $1 million in revenue. We want a $50 million valuation. And be like, and I knew I could either say one of 2 things, yes or no. Usually it was no, thank you. Then the next year it was, we are doing $1 million in revenue, we want a $50 million valuation. And what I would say then is, hey, a little higher than I'm comfortable with. Why don't you go out and test the market? And if it doesn't work, come back and we can talk about something new. And most of those people did come back within 6 to 12 months. Now, when people say I'm doing X and I want Y, I just say, you know what? That's not a viable deal. I can't do that. Let's talk about something I could do. So you're seeing entrepreneurs become more flexible, but it's going to take a while. I mean, they should probably by 6 months to fundraise if they're exceptional. And if they're not exceptional, they should keep working and not waste their time.
Well, from my perspective as a consultant supporting the fundraiser who needs the funds, I'm trying to be, let's say, give them mentor and try to cover the project at least to be acceptable from the financial point as a metrics, put it this way.
Well,
as much as possible.
That you can't impact that. The business is either awesome or it's not. I mean, first of all, what you should know about venture is venture does not love people in the middle. They don't like consultants.
No, I respect that, but under the sometimes you shift the cycle, which happen many times with the startup. Startup is like, all my experience is like, is proud about his own technology or his own service or his own product. But under the is when you put in perspective in the financial and say as a presentation, does it looks nice?
Yeah.
So we need to come and trim all
only
these
thing that
issues
sells
in
right
order to
now
make it
is
saleable.
Results, period.
Yeah.
End of story. So if someone says, oh, I have this great technology, look, unless you invented the iPhone, nobody cares. What's your ARR? And if you're not doing material revenue with a path to profitability, if you choose to take it, venture capitalist wants you to take that path if you can continue to grow in a material way. But net, this is a game of steak, not sizzle. So, you got to also think about it's very stage dependent. Pre-seed, $500,000 to $1.5 million is the only time people can raise money with PowerPoint slides and idea and great talent around the table. I do a little pre-seed, but I predominantly do seed. And at seed, $2 to $6 million, I expect $500,000 of revenue or more, and I've gotten as much as $6 million of ARR. The fact that people are doing seeds with $6 million of ARR and not doing Series A is a pretty telling statistic. But net, if you don't have at least 3 million of ARR, don't even waste your time going out for an A, unless you have just absolute superstars on the team and technology that's going to blow everybody away. And even then, you better have some decent ARR to back it up. Just my point of view from
Thanks for the information.
Michael Hammer.
So I just wanted to jump in with an LP perspective. And I'm in various venture and angel funds. And the fact is, there's too many mediocre funds out there not delivering the results. The carry, if somebody came back and said, I'm going to give you a real return of 30% per year, I'd say take a 30% carry gladly, right? But if funds are not performing as well as, let's say, the S&P 500, why should they get anything at all? That's just my opinion. So I've actually been going, and I'm more of an early stage investor. I've been going more towards just direct investments. I see enough deal flow from people I know.
Well, I agree with you entirely. I do a 0 and 50 fund if you want to, do it in a heartbeat. We give all our fees back unless we lose money, right? I've been doing this for 18 years. I've never had a fund that lost money. So, who knows? It could happen. But, one, I think people overestimate the importance of fees because if you're making good bets, you're going to get all those fees back. I don't get a penny of carry until I've given you all my fees back, and neither does really anybody else. I get bumps on 3x and 4x net, right? So I'm very motivated to have high performance. I'm putting in 10% GP commit myself. I care a lot. The problem is you've got a lot of, excuse the very crass term, feeders there who have grown their businesses over and over and over again to sizes that are unsustainable and can never deliver returns. There's a very famous fund I will try not to name. It's hard for me not to, but first letter A, last letter Z, that just constantly raises more money and hasn't returned for 10 years and probably never will. And yet people are comfortable buying it because they've heard the name. The right answer is not, I'm not saying you shouldn't do directs. Directs are useful. Directs are useful when you can rely on trusted parties that you don't have to worry about why they're giving you a deal. The worst deals usually come from VCs that could have done the deal themselves but then passed them on. But I've also seen historically that family offices and LPs that do direct investing, I mean, they're not generally getting the best deals and they're generally not getting great returns. So unless you're sort of doing what's very popular right now, there are multiple funds that have approached me where they basically say, look, we want to do the pro rata share of seed funds later in the top 10% seed funds. And that's a smart model because seed funds don't typically follow on a lot. But if you're getting deal flow from venture, if you're getting where are you based?
Ohio.
Yeah. So I would challenge you to tell me you're getting phenomenal deal flow in Ohio. I mean, I saw 8,000 deals 2 years ago.
The fact that I'm in Ohio, my ties are closer to the Bay Area and the Valley than to Ohio.
Right, but are you going there to get that deal flow, or are you getting them to send it to you? Because one is extremely draining and the other is extremely erratic. Meaning, thousands and thousands of deals to do one.
So, Michael?
My background is cybersecurity, so I know a lot of founders in that space.
Oh, that's an awesome one.
And the deal flow comes directly to me. They know me, I know them. So that's one case.
That's totally fine. You have domain expert founder relationships. That's awesome. The tricky part is, how much can you invest through that in qualified folks? Don't give up on venture. Picky about performance. I mean, you should, in theory. I've funded maybe half a dozen funds, and I'm not interested in the story. I'm interested in the track record. And if you can't show me a track record, now I've missed out on some things because I chose not to invest because of the fact they didn't have a track record yet. But unlike mutual funds where people can spin up 10 concepts, kill last one. They have 9 money losers and 1 winner, so they promote the winner as if it was awesome and look at how great they are. A venture fund is run by human beings, and human beings only have one.
But bottom line, venture fund, you were talking about the best deals. Look how much money has been going into AI. Is AI real? Absolutely. But should 34% of VC money be going into AI? Probably not. I'd be counter investing, looking for things that are not necessarily AI.
Yeah, that's
I
fair.
don't-
The last deal I did was a robotics company to fight wildfires. But the best and brightest talent always go to the most exciting area. And right now, that is definitely AI. So it is both probably as big as the web was and is drawing in all the most talented people. So if you're founder centric, you'll end up doing a disproportionate amount of AI just because that's where you're going to get the best founders. Now, the problem is there's going to be an enormous amount of blood, right? So you have everybody chasing every category. And, it's sort of with the invention of the automobile in the United States, there were 2,000 car companies. So it's very similar. Like, how do you figure out who's going to be Ford? And it ain't
exactly.
Yeah.
Let me ask a different question so we get more people involved. What does the Valley think of energy today? If Altman is saying it's all coming down to who's got access to energy, what innovations are we seeing on that front?
I'm sorry, Mark, you said it again.
I'm looking for innovations on energy other than better drilling.
Actually, I think they're drilling less right now and stating that they're going to drill less in the US, which is ironic. Because at these prices, they're not, a lot of them won't be seeing the same returns. So very interesting dynamic there, Mark. It goes against a lot of what the administration is trying to do.
I think also, Mark, it's hard to answer that question right now because the framework is, goes back to the BBB, the initial part of this. Like right now, they're completely altering the incentives for work and energy, right? So you're talking about effectively undercutting anything that's renewable and going, increased oil and gas, which, you can argue the logic of that, given that we were producing as much as we've ever produced over the last 5 years. And you're talking about nuclear. Nuclear is great, small nuclear, but there's a very small world of folks who work in that and invest in that. So right now, until you have that framework locked down, that's a really hard question to answer.
And Jeff, SMRs are still, for real applications, still a ways out, right?
I mean, everything. I just don't feel them now, but it's an area that I've worked with, and I know some of the guys developing that. But it's absolutely a ways out, and it's kind of the stage where tax incentives are going to help it all that much. Whereas kind of at the stage where you could mainstream a lot of renewables, but we'll see what happens with the framework.
And Jeff, we're going to see you on the West Coast.
Yeah, you'll see me on the West Coast for sure. At least in the Bay Area piece. I don't think you're in Seattle as much as I'd love to.
There's going to be it might be better even than San Francisco and the Valley. But okay, Samir.
Yeah. So about energy, I agree that the energy policy is completely messed up. Right. It's great if you're oil and gas. Clearly, they want to sort of promote that. I agree that there's a lot of opportunity being missed in renewables as a result. What I am seeing, Mark, to your point, is I am seeing investment in, let's say, how we use hydrocarbons sustainably, right? A bit of an oxymoron, but there are technologies that we're investing in which take the carbon out of hydrocarbons to just use the hydrogen, and then to sell the carbon, right? So those are, some cases where even though the tax credits aren't there anymore for zero carbon energy, we're still relying on the hydrocarbon infrastructure, which plays into what the administration is trying to achieve, while also achieving hopefully some of those sustainability goals.
Fair enough. Anthony, you're back.
Hi, look at VISTA last year, which is run by named Burke. Jim Burke is the CEO. They just acquired new multiples May 16th. So now they're going to guarantee 2,600 watts of power across nuclear, coal, solar, but mostly they got 7 new natural gas positions. And last year, if you just look at it, you know, I'm a public, that's my mania. But Vistra was up 262 last year percent with compared to Nvidia at 179 and Bitcoin at 108. So that is being regarded. People are paying attention to that. If you talk about the future, my take, and I'm looking closely at helium on the moon, which has quantum potential cancer and other benefits. In other words, mining helium on the moon, and I believe that's going to become defense critical.
How far out is that?
You mean when is that deliverable?
Mhm.
Hold on, you want the exact amount? I think it's several years. I think it's at least 08. So what are we now? We're 05. So that's 3, 4, 5 years away. I'm looking very closely now with a company where one of the co-founders built the US space station, Glenn Martin. I'm in New York. They're based in New York. And they're rolling. They have a team. They have a $1.2 billion commitment from the Department of Defense. But obviously they have to deliver on that. It's done robotically. Yeah.
Andy Fisch, thank you.
Yeah. So the so-called drilling is basically two categories. There's the short term. We can just put more holes in the ground where we've got them. But oil's $60 a barrel. You're down to a point where I don't know if anybody cares about tax credits because it's at $60 a barrel. There's not a lot of places you want to drill in the ground. The longer term so-called drilling is, yes, they're opening up the Arctic and other public lands for drilling, but those are long-term projects. If oil was at 90 a barrel, you still wouldn't see anything for some time. So my point is the bottom line impact in the time frame that is relatively intermediate, we'll call it, even in 4 or 5 years, is almost negligible. At $60 a barrel, it's zero.
Although $60 a barrel is a massive benefit for the global system for consumption.
Stephen, from a macro standpoint,
yeah, from a macro, I just
growth,
I want to just add
inflation,
that we've been very
100%.
negative.
Yeah, Stephen, 100%. I'm just talking about the drilling motivation is exactly zero, even with a tax change.
I want to get a new voice, if I could. Candace, can I ask you a question? Candace Beaumont? You may be just observing from afar. Okay, go ahead, Michael.
So I just wanted to jump in on the drilling discussion. Oil isn't the only
Sorry, I was
game.
muted. You could ask me a question. Sorry about that.
If you don't mind, Michael, pause on that one.
Sure.
Just curious, Candace, we've talked off and on, but you haven't been on this public forum for a while. But just what scares and excites you these days? We're talking about energy, but it doesn't have to be about energy.
I think energy is a great area. I mean, we historically even been with us and the need for it with data centers and other things, the need for energy is just ever increasing. So I think there's a number of areas in energy that are interesting. We're not looking at a lot of them because we're distracted with other things right now. Sandro, the billionaire I work with, his father-in-law just died of cancer, and it really kind of triggered him to look into ways to extend longevity. And so right now he's all in and co-investing with Sam Altman in an AI healthcare company that's basically trying to solve Alzheimer's and extend longevity with a number of different initiatives. And Sam Altman's leading it with 150 million, and we'll co-lead with 50 to 100. So that's one of the investments that he's really excited about right now in AI for healthcare. And I agree with some of the earlier speakers. I think AI, if you can back the winners in AI, and there's going to be a lot of money made there in AI. So, co-invested in a number of different, like Figure AI and a number of the other AI companies that are interesting. So I think that's something that's going to continue, you know, but I also think it's dangerous, right? I think it's dangerous and I think for society, if we go too much into AI or a digital economy, if the wrong person, if the CCP gets control of that quantum computer, we could be enslaved in ways we never imagined possible. So I think regulating AI is also really important to make sure it doesn't take over. But from an investment mandate, I think there's going to be a lot of.
You're going in and out a little bit, but I got the gist of it. Thank you.
Okay.
Good themes, and then we'll come back on that the deal you're doing with Altman on longevity. Anyone else? I guess Michael, back to you.
I just
Since you're-
wanted to correct the date on the helium. It's 2030, not 2028 for delivery. 2030, 7 years and ticking.
What kind of volumes are we looking at delivery of
It's
helium?
big. 1 second. Wanted to be specific.
But let us know.
30, potentially, it's a big number, 357,000 kilograms will be needed by 2050 for fusion and quantum. But that wasn't your question. Your question was delivery. Current reserves are 29 kilos and 15 kilos of new production per year, ongoing from 2030.
Okay, I'll later put that in perspective.
It's complicated. There's 1.1 million tons of helium on the moon, according to NASA. Enough fuel for 3,000 years of fusion power generation.
Okay.
Anyway, happy to talk about this further.
Yeah.
It's obviously extremely complicated and scientific.
Andy Fisch, did you take that into account in your various scenarios?
He's talking about things like deuterium, and yeah, we don't have the technology to actually use it yet. So when we invent the fusion reactor, then we'll need the huge quantities of things like deuterium and helium to put into it.
Well, Michael Hammer, you're back to basics. Oil and
Okay,
gas.
back to basics. So Andrew was talking about drilling, and I'm, like I've said in the past, I'm focused on the Utica. Even through the windows, I can hear the they're putting in a new pad about 2 miles away. And in this area, it's primarily natural gas. And while oil has come down significantly, natural gas is still pretty up. So the peak recently was a little over 4, I think it was about 4.25. Currently, we're a little over 370. But that's doing pretty good compared to last year and the year before, when it was down around 2 at Henry Hub. Drilling continues in this area. Prospects look good, but you have to understand, they don't just like start a well pad, drill the wells, put them into production. What happens is they'll drill a well and they may wait to frack it, just holding it in inventory, and then go back later and frack it and put it into production. There's limits on the amount of pipeline capacity. I think pipelines are generally a good investment, whether it's oil or natural gas. You've got new terminals coming online in the near future. The upside to that is more export sales. The downside is more exposure to international markets. So natural gas becomes more like oil in that sense.
So Michael, you're absolutely correct. Remember, I said there's the camp of we can just put another hole in the ground. So if you look at Utica, you've got two things. You can put another hole in the ground. And two, you also have pipelines. You're completely correct about natural gas, a much better dynamic than oil. And it will be, by the way, because all the electricity needs will drive nat gas demand, even domestically. But it's got to be near a pipeline, which Utica is. And once again, you're just putting another hole in the ground, not creating a whole new thing.
Let me just,
And Andrew, understand, they had to build those pipelines, and I was here when they were building them, right?
Oh, I
And
agree. I'm just saying, Michael, you're right. I'm saying they're there.
guys, we have like other people, just thinking of other questions that might be on people's minds.
Mark, I have some that flew under the radar last week, but the Supreme Court stated a view, which wasn't a ruling, that Trump could fire some of the people he was trying to fire, but when it came to the Fed, they maintained they had the view that the Fed is unique in constitutional terms, suggesting it intends to maintain a carve out for Fed independence, as it appears poised to expand greatly the president's ability to fire other agencies. But the Fed one, for right now, is pretty much been told to keep hands off. And I think that's going to be an interesting dynamic to see play out. But he'll go after other agencies, but I think he'll give, he's moving now to where he's better off waiting on Powell. But I think that fear should be reduced, if not off the table for people.
Got it. Thank you. Anyone else with a comment or question? I had a question then on pipelines. Is anyone aware of the pipeline Russia's building to China? Any insights on that? Because that came up in a lunch yesterday.
They're doing it because all the Arctic natural gas that the Russians produce there's special LNG and icebreakers that bring it up and around and down to China. And so that's where the source is in the northeast of Russia. And it's just a way of avoiding the shipping that they're doing today.
But in a time of war, just as Nord Stream was disabled, bombed effectively, what stops the bombing of pipelines, interrupting gas transport?
In a global war or
Well, so I had a Singapore, mainland China, and London-based ex Singapore discussing geopolitics, and they're absolutely convinced that in 2027 China will have the full capabilities to take over Taiwan easily. They make ships and bombs like chocolates, they were saying, and that they don't want war, but they're going to take what's theirs, and they and what can be done against that dynamic. If you want to do something, the Americans will not put any soldiers in any harm's way, and so that you should just plan for. And there was then the discussion of the Ukraine-Russian war. Couldn't have been nice if we could make nice. Any news on that? I don't see Adam Blanco. Any news on the war? Germans are basically saying you can bomb anything anywhere in Russia now. Did you see that?
China's going to blockade Taiwan when their merchant fleet is large enough, and their merchant fleet is built to military standards. So they're going to shoot.
That point I get, but what about I forgot that other point. What about the fact that Germans are allowing Ukrainians to bomb anywhere in Russia? There's no limits now. Has anyone picked up on that?
Yeah, Mertz came out with that today, Mark. And I thought it was interesting, and that they're
so Mario, is that thumbs up? You like that, or what's the point?
No, I'm saying he was out with that today, and I think it's a reflection of Europe trying to say that they're going to stand up regardless of what the US does. And I think they needed that message to be different because I don't think Trump would have put that message out.
Yeah.
So I think there's a push to stand up as if it's without the US going forward.
Right.
Yeah.
Maurice, you wanna
To
comment?
paraphrase with less polite words, maybe we needed a bully to get finally cojones to our decisions, and I think we getting very well together. And let's hope that the next election in Poland will also be to the right direction. Then things will follow. So I say, good luck with the gas pipeline. Yeah,
So,
as long as no peace deal is made.
Gunther just jumped on camera. Do you want to say something, Gunther? Hold on.
Sorry, yes,
Can I say something?
the main reason why Germany allows now to use long-range missiles is to defend against the aggression from Russia. They only allow to bomb places where the rockets are starting, you know.
Yeah, okay.
Rockets and so on.
Gunther, do you mind introducing yourself to the community?
Well, I am based in Germany, next to Frankfurt. I am partnering with Joe Milan and some other American partners. I'm a fundraiser for impact-oriented startups, mainly in Europe, Africa, and North America.
Great, welcome.
Thank you.
Maher.
It's
sorry.
it's
One
only
second. Go ahead, Anthony, go.
it's only appropriate that Gunther's from Frankfurt, and a week ago, you know, you raised it. You didn't ask. Ray Mental, it's up 6% this week since the last meeting, and it's at a new all-time high today of 2.5. And I gave it to the group at what, 1100, and it's trading at 1889 now, and all in part to the war, to Germany, Ukraine, in part, not in total, with 70% of the revenue coming outside of that, to most people's disbelief. But we have to admit it's an absolute ballistic run. And you could argue that, and I didn't read this is what I'm saying. It's kind of like the Mag 7 of Europe, but no one said that yet, but they will. It'll come out soon. And we're up 212% year to date on Rheinmetall and 254% in a year. Where is it going to be in a week and a week after? It's clearly going over 2,000 and very quickly.
Okay. Maher?
I don't know.
Well, there is a deep analysis regarding the issues going on in Europe. In my perspective, like, you know, when American now, Trump, I feel is more rational to say, let's settle down because, you know, we know that all the wars is coming end of the day to the table, back to the table. You know, there is no other solutions other than back to the table. But end of the day, I feel like it's sad that you're.
I'm missing that word, Maher. Back to the what?
Everybody say after the war, end of it, everybody's back to the table and closing the issues. The point is, like, you know, burning more resources, cutting funds from the people's life. That is what I feel like some people driven with this in order to keep more harm in Europe, which I feel bad for it. Bear in mind, a Russian economic, maybe you can trust it or not, is being increased. Like there's a growth out of 1 or 2% last year. Maybe that's wrong or bad, but I'm in touch with some people, my friends living there. They said things are settled down. We don't have any hardship. Everything's normal. We are making living. We are covering our cost, and we don't have any hardship. Having said that, is China on the other side is not acting 100% side with Russia because there's a lot of mineral resources discovery in the China Sea at the moment. So things are developing. China is always acting, as we said last time, strategically for her own interest, for Chinese interest above of anybody else. So having said that, is like, you know, I feel like, you know, I trust Trump that say, when he say settle down, enough military complex, you know, fueling all the money into Europe and keep the war, the fire is, you know, oil to the fire. That's something is what I just want to address. Thank you.
Well, it's 12:20.
Mark, I want to leave with one last thought, which is what I started with. I think the debt problem around the world, which we used to say is down the road, is getting a lot closer. And I think people need to really focus on the areas they're investing in, the debt levels, whether it's countries or companies, because the bills come and due. And you're seeing it with Japan is starting to, we're going to have to get buyers for the debt, and the buyers are not going to buy without a higher rate. And I think that's going to push rates up and make all our investing approaches more difficult. And I forget who said it earlier, but the focus on quality in the venture, I think you're going to need to focus on higher quality throughout, as we're going to be pressing up with the rate structure around the world because the debt burdens.
You mean it's going to be about steak and not the sizzle?
I think we're getting back to way before 08 investing,
Right.
Before we went to zero rates.
I mean, Japanese bond investors have lost, what, 25% in a couple of weeks? But just on that, Stephen, could you just in closing here elaborate, because I think you've hit it and you've been, talking about this for a while, but it's not just US, it's a global rate problem, and how that parlays into the stock market, where the question is, what catalyst is there? Because we've all been glued and addicted and lulled by the S&P meteoric decade of rise. But what catalyst, if any, can maintain that? And maybe the right question is, what prevents that from not just going sideways, but in fact having more than a hard fall, which in my mind constitutes, when you're down high teens into the 20s from here, then that has a real pain. And so, earlier there was that rotation out, and then last week, and you were saying how you thought, and before how you thought that was just temporary, how capital would flow back into the US and into the S&P, which it seems to be. But my question is, what's the setup for things either to work or for it not to happen? So how does it all get recalibrated?
Anthony, to your question, I think the debt problem pushes people to focus on changing their discipline, because we didn't need much discipline for the last 15 years as investors to make a lot of money. And now you do. So I think the debt problem leads to better fiscal discipline, which is going to push people to be more productive. And I think the productivity side, what excites me is the productivity opportunity ahead of us. And it's the ability to capture that's going to offset some of these challenges. And in the US alone, if we move to better productivity growth, you could see us jump from 1.5 to 2% growth to 3% growth here. And just picture every country getting a little bit of productivity improvement would go a long way to offsetting the debt burdens and getting you back on a more sustainable path to offset the problems. And I think that's really where the yin and the yang are. You have the debt problem on one side, and you have the innovation on the other that's driving the productivity improvements. And it's just a question of, you need the impetus to get people out of the complacency that they're in, that don't worry about it. The Fed put will come in, or the Trump put will come in, or some other central bank will bail you out, or there'll be a big fiscal stimulus. And I think we are pushing the limits on all of that. And now we're getting back to where you're going to actually have to deliver on productivity improvements to drive the economies forward.
Mm-hmm.
No, that's the number Besson said, 3%, right? Sooner than later. He's very clear about that when he was interviewed last Friday. Well,
if you get it right, he's been on that for a while, but if you get it right, you can drive productivity up. But you can't waste money the way zero interest rates allow you to waste money. And I think everyone's going to have the discipline. But for us, we always start with, there's three things that matter for security valuation. One is the outlook for earnings, the outlook for interest rates, and the outlook for inflation. The outlook for inflation is muted. The outlook for interest rates is, I think, range bound plus or minus around here. And the outlook for earnings is struggling right now. But for the companies that you have clarity, you can make some good money in. I think that's the way people have to step back and look at it now.
I was just about, maybe this is sort of a wind-up comment. Marius was asking, do we record these? Well, hell yes. They're always recorded, as you know. So the video you can see from last week, which is, you can go to we have a YouTube channel. We don't promote it very much, but there's Anthony right there. But you also have transcripts, which you can get on the digest. And actually it's in the body of the description of the YouTube. But right here, I think this is the fascinating bit. Or you can see who said what when. Or we have podcasts on Apple or all your channels. So if you didn't know, he asked. So I can't believe how many we have 676 episodes.
I'm surprised not more. It feels like more.
You just have to be right 51% of the time, Stephen, and you're a genius.
Anthony, if you look at Rafael Nadal, won 83% of his matches and 53% of the points in the games he played. So keep that in mind for investing too, because you got to be right overall a lot more, but you're not going to get it right every day by much more than 50%.
Unless you're on the wrong side of a short. Yeah. There's no such thing as a short in tennis. I'm just saying, having taught tennis for 3 or 4 years, but